Hello and welcome everyone to the Almus YouTube channel. This is our weekly windup series, and I'm your host Swaraj. And with me, I have our market expert JK. Now, as you can see, both of us are at home. Behind me, you can probably see the Formula One posters, and right now there is a qualifying session which is going on. A very tight battle between Ferrari and Red Bull this season. So very interesting, and markets have been interesting too. JK, this week we saw a lot of data being released, especially from the US. We had some recovery in the euro. We had, of course, we are going to discuss the same. Now, I want to take you through the first data. Like we had the PCE inflation data yesterday. At the same time, we had key data like PMI, which saw a dip both the manufacturing and services as compared to the previous month, as well as housing, which seems to be like the rate of new sales seem to be falling. JK, what can you tell us about this change in narrative? Like, because once we had this phase where the dollar was increasingly, the dollar index was rising exponentially, and now it seems to me that because of some slowing economic data, market is repricing, okay, what the Fed might actually do in the future. It might not be as aggressive as people thought. So what can you tell us about the same?
Yeah, thank you, Swaraj. A very relevant question for these times. In fact, a lot of attention is being paid to the US economic data, other than inflation too, which is to assess whether the tightening financial conditions and increased official rates, as well as the continued supply chain issues, have an impact on the activities. Yes, PMI came much lower than last month. In manufacturing, it was 57.5 versus 59.2. Services was 53.5 versus 55.6. New home sales dropped by more than 15% as the increased prices in mortgage rates impacted demand. Last month number itself was showing a drop of 10.5%, which means we have a continued fall in the home sales. Another indicator, the Richmond Fed Index dropped as low as -9 from +14. Now we come to the GDP second estimate for Q1 that again came in the negative at -1.5%, and following almost a similar number last month. And trade balance continued to impact growth besides lower inventories and government spending. Only the personal consumption was up 3.1%. Finally, we had the Fed's favorite measure of inflation on Friday, the core PCE for April, that was 4.9% year on year versus an expectation of 4.9%. But the reading in March was 5.2%. And this is the first drop in index for the last 17 months. Headline PCE reading was 6.3 year on year versus an expectation of 6.4, and March reading of 6.6. Recall that April CPI reading was 8.3 year on year versus 8.5 in March, while the core was 6.2 versus 6.5 in March. Thus, there is a trend of small softness in the inflation data, which is giving rise to a decreased expectation of aggressive Fed rate hikes and help the dollar to sell off. I read these with one of the Fed members' statement that Fed may have to pause after two hikes of 0.5% each in June and July. Markets have actually reacted to these data and statement by pushing down the yields. 10-year down more than 50 basis from the top, 30-year now consistently below 3. Dollar obviously had a week of significant loss, dropping by nearly 3% from the top, led by Euro, where the ECB members, including President Lagarde, have been now sounding more hawkish. Yes, there are some signs of activity slowing in the US, but we would be much more closely watching the upcoming employment data next week, for which the Fed gives a lot of weightage, because their super hawkishness started when they found that we were almost reaching the full employment status. Does the US economic data trend, along with the ECB holding a bigger sway over the dollar index, is going to be the trend in the coming weeks. But how far for the euro or even the dollar index will depend a lot on the employment data.
Okay. And JK, touching upon a point you mentioned, that US 10 years saw a cool off. Now here we have graph which actually compares the US 10-year with the Euro 10-year. It's basically a difference. So falling difference basically indicated what you just mentioned, that the US 10-year was actually coming down. At the same time, we had a rise in the Euro 10-year, which actually narrowed the difference between the two. Uh, so really a different, like some changes which are happening, especially when we are seeing ECB, they are saying that they're going to soon stop their asset purchase program and start hiking rates. Uh, what is the situation in Europe right now? Because we are seeing a war which is prevailing, high oil prices. Uh, can Europe really afford to start raising rates without like triggering a recession? What is your sense of the developments which are happening in Europe?
First, let me touch upon the relation that you showed between the yield differential and the euro. It is a very important factor in euro trend, but only one of them. Higher yield in US relative to European yields have been driving the single currency lower or the dollar higher, but other factors have been at play as well. In the chart, you have shown 10-year yield spread has narrowed by about 30 basis points recently, 175 versus 205 in the beginning of last week, which means the attraction of US bonds has reduced and euro has rallied by 3%. But there have been instances also where differentials were even higher, but the euro was also higher than the current level. So I am trying to say that this is only one of the factors. Dollar demand recently is also due to the safe haven flows after the war in Ukraine, threat of euro slipping into stagflation, particularly if there is an oil import ban from Russia, and the super hawkishness of Fed related to ECB. Unless these adverse conditions to the euro change for the better, it is not necessary that euro should rally along with further narrowing of differentials. While ECB stance is changing, other negatives will take time to turn. But we do have some other positive numbers, like we had German IFO business indicator index, and then we had the GDP. All of them are coming much better. In fact, PMI from Eurozone was also much better reading compared to that of US and the UK. So there are some data supporting the Eurozone's hawkishness, and Lagarde is now more consistently talking about a turning point for the ECB rate path, which should be happening in July. So it's not just the uh, you know the change of interest rate direction, but also the change of economic data direction, which is supporting the euro much more. But as I said, the war in Ukraine and the oil price threats will hold much bigger sway. And once again, to repeat, the yield differential will be only one of the factors, and it will have a more influence when the trend is also on the same side.
Right. So as JK mentioned, the yield differential is only one of the factors, and right now, in his last statement, he also mentioned that the war is going to play an important factor coming forward. Uh, I want to touch upon my last topic of conversation for today. On the domestic front, we saw the RBI pay out a dividend to the government of India. So JK, could you please explain? Like, what is this concept? Why does RBI pay out such dividends, and what is its significance? Because we are seeing a declining trend uh, in what RBI has paid out to the government. So what is its significance?
Yeah, it's a very important factor in the current situation, particularly on the fiscal side for the government. RBI always pays out dividend to the government because RBI, though it is not a commercial organization, they do end up turning out surpluses in their books, and being a fully owned organization of the government of India, the surpluses are transferred, or a major portion of the surplus is transferred by way of dividend to the government, and that has in fact formed a good part of their budget planning. Now, for this year, they have transferred an amount of 30,307 crores, and this compares with 99,000 crores of last last year, and this is like a much bigger drop, considering that last year's number was almost 10% of the overall budget deficit financing that the government would have done, but this is much, 30,000 is a much lower number. And it is the lowest in the last 10 years. Now, government had actually budgeted over 70,000 crores from RBI and PSU banks, but it is much, much lesser than those expectations. And that is going to play a big part in the budget financing or budget deficit planning by the government. They already have a huge borrowing program, and that is going to be affected. And this will also have an impact on the GSEC yields. Now, let us also consider that the lower dividend is also a result of yields going up in the markets in India as well as abroad. And RBI has a huge holding of Indian GSECs as well as the overseas, government bonds. And when the yields are going up, obviously you end up losing on your bond portfolio, and that has resulted in a much lower profit for the RBI. And this will have a fiscal impact for the government, and probably consider this along with the fact that government is doing more on the fiscal side for controlling the inflation, like export duties and reducing the imports, etc. So we definitely have a situation where the lower dividend is going to add to the budget deficit of the government, and it's something that we will have to watch out as far as its impact on the government deficit is concerned.
Okay.
Yes. Let me also say that worse deficit will be another negative factor for the rupee in the coming weeks.
Mm-hmm. And JK, just to consolidate what you said, because RBI holds a lot of bonds in its books, when the yields go up, the prices of those bonds fall, which result in a loss in the portfolio, which actually resulted in a lower dividend payout. Is my understanding correct?
Yes, you're right. You're right. They hold a large portion of their surplus in government bonds. They also buy a lot of Indian government bonds whenever, during the post-pandemic period, when they were infusing a lot of liquidity. One of the market operations was to buy bonds from the market and give out liquidity to the system to tide over the tight situation at that point of time.
The quantitative easing program, or as it is known in the
we did not
world.
call it as QE in India, but definitely effectively QE.
Yeah. In the Western world, it's known as QE, right? Yeah. So that was actually very insightful. I definitely learned something new with respect to the RBI's dividend payout topic. I hope even our viewers learned something new tonight. That's it from our end, everyone. I hope you all have a very good weekend. Thank you.
Thank you, all of you. Have a nice weekend. Yes, we look forward to the IPL finals tomorrow. Probably we'll have a new winner tomorrow.
Yes, for all the cricket fans out there, there's IPL finals tomorrow. JK, are you a big cricket fan or a Formula One fan?
I am. Formula One, not so much.
Okay. All right. Thank you, everyone. Thank you.